Just wanted to make sure everyone can hear me. My name is Antoine Anderson, and we will be presenting document management and financial reporting. Also have Monet Cromwell with us as well. We are an ANC management group, and we're with the BCYF, which is Baltimore City Youth Fund. And I'm glad to have everyone come out this evening. And we want to have an open dialogue a little bit in reference to document management and financial reporting. We put together a PowerPoint presentation to provide some different insights on document management and financial reporting, and we wanted to go through that with everyone. Let me get started right now.
Antoine, your sound is a bit muffled.
Okay.
Yeah.
Yeah, is that better?
That's better.
That's better? How's that? A little bit better?
A little better. Yep.
Okay. All right. Trying to get the mic a little bit closer, as close as possible. Okay. As I was saying, document management, let's go to the first. So there we go. So tonight, what we want to discuss is what is document management, what is financial reporting, expense reporting, allowable cost definition examples. So what we want to do is try and go through these various topics and try and give you some insights on different things and hopefully answer all your questions and make sure that everyone has a clear understanding of document management and financial reporting, a little bit of background and where that came from, and also how we can use technology and move us forward throughout the future as well. So what we like to do is always use a little slogan or term: work smarter, not harder. And that's what document management it was set up to do. It is a system eliminating paper files, basically going paperless. We put a brief overview of a semi-definition of document management. There's a group of systems, as you'll see, that we'll relate next on the next slide. But what we wanted to do was give you, want you to work harder and not work smarter and not harder, and not work harder on doing all of your preparation for your financial reporting, maintaining your office, or maintaining any sources at home or anything, utilizing technology to help you move forward. As you see, some requirements that may be needed for you to have this happen is a printer scanner fax. Now, those are combos that they came out with a few years ago. Remember, a long time ago, probably before me and anyone else, it was all a printer, then a scanner, then a fax. And then they came out with a printer scanner fax. And now they have multiple things, small scanners that can just be handheld scanners that you can carry around and scan. And a lot of those are great to utilize because sometimes you're out and about and you may have a receipt or you may have an invoice, and you can take the scanner and just scan that using your phone or even using a scanner or anything. And then you can upload it into your software, to your file sharing. So what else you would need is an email to be able to email that. It can be saved on your phone and take it and attach it and email it from your phone. You just need the internet connection, hotspot or something to be able to utilize. But one of the primary pieces that always go overlooked is some type of security that you have that allows you to be able to make sure you're securing your documents so that people won't have access to it. In a larger organization, when you're looking at a business, you want to follow the big three, as they always say, from a security standpoint, internal controls. And that's when you are trying to make sure that you have authorization, custody, and also recording separately. So you want to have those three separate. But when it's just you, yourself, and you're doing personal things or you're doing a small organization, make sure you have yours password protected. Some of them are password protected that it can't be unlocked without facial recognition, a code, or even a sign in as a backup on your phone before they allow you to do certain things. And all those system requirements are very important because you're uploading and scanning sensitive data that may have numbers on there, such as your account numbers or your EIN numbers or any account numbers that have access to different bank accounts. And that's just very important to make sure you maintain and keep separate.
Antoine,
Yes.
quick question. Are you utilizing a headset?
No, I'm not sure why it's like that. Let me see. Hang on for 1 second. Hold on 1 second. I'm gonna see, can we switch to a phone, and then that may be a little bit better. Hold on for 1 second.
While we wait on Antoine, I guess I can do some comedy while we wait. Just kidding.
Shaq, I think you should do the comedy.
Welcome to Zoom. Enter your participant ID followed by tab. You have entered the meeting as a panelist. Attendees can now hear you speak. This meeting is being recorded.
Can you hear me?
Yes.
Is that better?
I think so.
Yeah, is that better?
Yeah, that sounds better.
Okay, good. So, sorry about that, you all. I think I left off right there with the security and a part of the required things that's needed for document management. Let me move to the next slide there. And what that is important features in document management. Now, you have a lot of important features that document management comes with, and not all of them will be utilized, but you want to try and utilize a lot of them as much as possible. And the more that you utilize, the more accessible and the more you will have to be able to vary and utilize and move around and be able to do things on the go. And you're not confined to just in your office, in your home or in your office, or just at a computer. For instance, you want to have your file structuring that may be in the cloud. You want file structuring is how you structure your files in the cloud or on your system between the different folders that you may have. You can scan using a big copier, printer, fax, or you may just use your mobile scanner. Indexing, versioning, integrations, mobile access, sharing, security. The biggest ones right there is sharing the documents with someone or having the mobile access. That's a major part to allow you to have the freedom and accessibility to move around and still keep being able to be on the go. Things have changed now that you're not confined to being in the office. Of course, people are working virtually. You can be in another country. You can be on the beach in Miami and still working and relaxing and doing file sharing and also mobile access through your phone to be able to keep moving. And the only thing you need to worry about, in my opinion, is just the security and make sure that you're watching your security that's around to make sure no one's having access to your information. Purpose of saving your time and money. Again, security, transit, securing data in transit and at rest, email security, sharing files securely, quicker accessibility, as I was mentioning, and consistent folder structure. That's what's going to save your time. Those three topics right there, they're the ones that's going to save your time. And what you're trying to accomplish is all the jumble, mumble, and all the papers everywhere and move forward. And I have an illustration that shows that so you can see what I mean. To the left, you have all those files on your desk, and then you have someone in the middle running around saying, what's going on? And then all of a sudden now you're starting to use data document management. You're starting to scan the items in and start to put items away, and now you're sitting back relaxing. And that allows that. Now, is it that easy? Not always. Will it happen over time? Yes. So let's relate this up until this point on how this may happen in your organization and what you're doing with BCYF. For instance, there are documents that you have that, of course, BCYF is going to require that you have to scan those documents, present those documents as supporting documentations with your expenses to support the numbers that you're putting on your expense report. Those documents, we're somewhat doing document management right there. We are asking you to support, send over those documents to support a line item. You may have that in the cloud, share that with us via email, or share that with us through access your information, or you'll utilize our software, the changes that we're doing currently right now to make things more accessible, and you're uploading and scanning those documents into the system. And then we're able to access those documents and see those documents, have the supporting documentation, and there's no paper actually being sent, no fax, no mailing of documents. Can you imagine how it was back in the day if we were trying to do this right now and someone had to fax over all those documents or they had to mail all those documents? That would be just outrageously crazy that some of that is going on. I can't imagine how that would be. Financial reporting. Financial reporting is the process of communicating and documenting financial activities and performance over a period of time within a company. It is a report understanding how much money you have, where the money is coming from, and where your money needs to go. That's just like everything you do at home with your monies that you have at home. Where's my money? Where did my money come from? It came from my job or what I made when I was earning as an entrepreneur, whatever. Now, where does it go? I can't believe that I spent that much money this weekend. I don't know what happened. I started on Friday and with $100, and now on Monday I'm -20. I'm -20 because I had to borrow some money from someone just to be able to get home. So that right there is different ways of financial reporting, but just in your pockets. Financial reporting inside of a business is that you're putting it on your actual financial statements and looking at your revenue, and you're looking at your expenses, and you're looking at how it's documented on your revenue. When did you receive it, or did you just invoice and then now you're recording it? If you invoice and record it, that's an accrual base. If you're waiting till it hits your bank account, that's a cash base. Just like expenses. If you're waiting till you actually use your card to pay, or you actually take money and pay by cash, for instance, which is very, I have to definitely have supporting documentation for that. That's reporting on your expense report. Or you just say, hey, I received the invoice and now I will pay it within the next 30 to 45 days. That's under the accrual base. And I'm mentioning accrual base because you hear a lot of that as time goes on between cash and accrual. Again, cash is when you actually are expensing the money out, and you're actually expensing the money out, and that's when you pick up the expense, or you're actually receiving the money in as revenue and it hits your bank account. Accrual is saying, I sent the invoice out and I want to get paid. Well, I pick up the revenue because I sent the invoice out, or I sent the invoice out to be paid, I received the invoice and now I'm recording the invoice because I owe this bill and I'm picking up that amount on my expenses. What's the major difference for a lot of people that they understand a lot of is when it comes to taxes. You could potentially pay more under the accrual basis than you would under cash. For instance, you're in receipt of a grant and they say, okay, this grant is we're going to give you this money over the next 3 months, and we're going to give you $100,000. Well, no, let me say over 3 months. We're going to give you this grant. You received it in December of 21, and now you've been awarded the grant for $100,000. And here is your award letter to say you received it, and we're going to send this out to you. And under accrual basis, you have to pick that up in December of 21. But you may not receive the money until March of 22. Under a cash basis, you would have picked it up in March of 22. Under accrual basis, you'll pick it up in December of 21, even though you haven't received the money. Now, the period of time between December and March is what you call accounts receivable or grants receivable, saying it's due to come in. Now, some people say, well, that's not a big deal. Let's say now they default and they don't give you that money. Your taxes, if you are not a nonprofit, or whether you're a nonprofit or not, you would pick up that money in December and show that as revenue. If you were paying taxes on that money, you have to pay taxes on that money in December of 21. You said, but I didn't get the money. But no, we're talking about December of 21. That's when you have to pick that up. And you have to wait all the way to next year to claim it as a bad debt to write it off. So that's why accrual basis could also hurt you as much as help you. Accrual basis is the building blocks of accounting. That's what everyone follows on the larger companies and mid-sized companies, but they do that because they can handle the revenues that's coming in and when it's being recorded, and also the expenses going out. Smaller companies don't have as much cash flow. That's why they stick to a cash basis of accounting. Benefits of financial reporting, like I was saying, tracking your cash flow. Evaluate your assets and liabilities to see how much I have in the bank, how much I have in assets, what's my receivables versus how much is being paid out versus how much I owe, and that's exactly what you want to look at, how much I owe. Measuring my profitability, that's the monies that you have come in versus what's going out, whether it's accrual or cash, what my profitability is. How much am I profiting? Am I making any money? You also look at support financial analysts in decision making. Those help you make decisions in what you do. You can't make a decision if you don't know how much money that's coming in or how much money you're expending out. You can't make a decision. You could, but you could make the incorrect decision. Let me say that. Managing your debt. That's almost like when you're buying a house, they want to know how much money you're making and how much money you're spending. And that's allowing you to manage your debt to see what you can afford. That's called your DTI when you're buying a house, a debt to income ratio. The same thing when you're going to go apply for a bank loan. They look at a current ratio, asset ratio, and your debt to income ratio. How much debt do I have for all my assets that I have? And that's what they're looking at. Simplifying your taxes. You want to simplify your taxes. Why is that so important on financial reporting? You don't want to go and see your tax preparer with a shoebox of receipts and a whole bunch of papers to say this is what I made on a bank statement. You want to simplify it by having one statement that says this is how much I made and this is how much I spent, and I'm going to show you that in a minute. And you want to be financial transparent on what you're making and what you're earning. That gives you the benefit to say I can make informed decisions because I know I have a profit of $5,000, $50,000, or $100,000. That's the difference of whether I can afford to go out and buy a asset to make more money, or to go out and afford an office building, or if you're only a personal, that I now got an increase in my job, I'm spending out this, now I can afford to buy a house. All of this helps identify your past and your future. Like I said, I just got a raise. Where in the past I couldn't afford this house, but now I can because of my raise. In the past I couldn't afford an office building, but now I can. In the past I couldn't afford to have my summer camp for the youth, but now I can. So the financial statements and managing your debts help all of those different things to allow you to be able to do all of that. Different types of financial reporting. This is more labeled in layman's terms for a for-profit, but I'm also use the terms for a nonprofit. Balance sheets, also known as the statement of financial position. A balance sheet delivers a total of a company's assets or organization's assets, liabilities. Stockholders have equity, but in nonprofit world, net assets at a single point in time. Income statements, we utilize that as calling that statement of activities. Financial statement that shows your company's or organization's revenue and expenditures. Cash flow statements, universally same type of statements. Cash flow says this is actually what I had started within cash in the bank, and this is what I have. This is the end, and all of this statement shows all the in between. I either spent money here, I earned money there, or I spent money to pay off this loan or to pay off this debt. Now, statement of shareholders' equity is more for-profit, but you also have a statement of net assets, and that is for a nonprofit. So different titles, same meaning, different titles, but they all fall under financial reporting and all fall under different financial reporting for what you may be utilizing. These statements, you say, why do you use balance sheet and not nonprofit statements? Because we have some that are for-profit organizations that may need a physical sponsor to be able to run, have the funding come through. And then we have some that are nonprofits that they understand the statement of financial position, statement of activities, cash flow, and statement of net assets. Here's an example of the statement of activities or statement of income. Again, revenue that came in, $200,000 in cost of goods sold because you're buying and selling things, and such as a restaurant or some type of clothing store or some type of things that may require cost of goods sold. You have a gross profit that's remaining, and then you have your depreciation and amortization, which is important because certain things have to be spread out. You have your interest at if you had a loan, but at the first one, you're looking at your general and administrative items, but you also have what you call program items and also G&A items in there. That all falls under the same category. and then you'll have interest income at below that, and then if you have earnings before taxes, income tax, and then net income after that. I do like to show these type statements again. I just want to reiterate, I don't want to focus all the time on nonprofit. I want to show you for-profit because it matters on both sides. It matters on nonprofit because you may not have this, that you have to pay taxes, but you do on for-profit. But I must mention, in some cases, nonprofits do pay taxes. Please, everyone know that if you do something outside of what your mission is and what your nonprofit is set up to be, that is what you call a 990T that needs to be filed. That's called an unrelated business income. And you do have to pay at a standard corporate tax rate, which is at 21% on the federal. So that is non-related business income. For example, I started a business and I started a nonprofit organization, and I just wanted to provide youth services to people in the community. But then you come out and say, well, to do that, I want to sell plates of dinner to everyone in the community, and I'm going to make money off of doing that. And you start earning a good substantial amount of money, and you say, well, that's a part of my mission. No, it wasn't. You're earning monies on selling plates of dinner, and you're not giving it away. You didn't use any of your monies that you received from contributions, grants, or donations to make the plates and to give away. You're also earning money. That is considered unrelated business income because it had nothing to do with you providing in the community, but for you to make money as an organization. So then you would have to file what you call a 990T and do an unrelated business income tax return. Balance sheet or statement of financial position. End of the day. That just shows your assets, liabilities, instead of shareholders' equity, net assets, and basically assets must equal the liabilities and shareholders' equity, or liabilities and net assets. They must equal at all times, and that is how you file and show how those match. For instance, you have your current assets, as we mentioned earlier, cash, accounts receivable, grants receivable. If you had a business that had cost of goods sold, you will have inventory, prepaid investments, depreciation under your fixed assets for property and equipment, and then other assets, intangible. I started a business because I started trying to think of a good business that may be amortized. If you had a startup cost because you bought into a franchise, that would be intangible assets. Another intangible asset is that you received a nonprofit organization or even a for-profit and you had goodwill, then that will be spread out in tangible assets. Then you also have liabilities and shareholders' equity or net assets. Liabilities is going to stay the same. You're always going to have people that you owe. There's always an old saying, you got to spend money to make money. If you're not spending any money, then you're not making any money. And if you are making money, you're only making a little bit, you're not making a lot. So you got to spend money to make money. Always remember that, because what happens is a lot of persons say, I don't understand that analogy. Well, if you're saying that, I don't understand why I got to spend money to make money. You'll be surprised when you hire someone to be as a staff or as a contractor or someone to help you out, they're taking on duties that you were doing, and that frees you up to allow you to be able to do other things, such as could be marketing, advertising, professional business development, and next thing you know, that revenue goes from $10,000 up to $50,000. The only thing that you have to watch is budgeting, which is an essential part of every business, to make sure I don't go overboard and have and spend too much money, and that I didn't budget to make sure my budget to actual and what I'm spending is correct. We work with a lot of grantees, subrecipients on different organizations, and a lot of them did not want to look at budget to actual. That is very important. You set a budget every year at the beginning of the year of what you think you're going to spend. You don't change it. And then every month you look at your actual, what you're spending, and you compare the budget to actual and see the difference to see if I'm on target. If you're not on target, that means that budget didn't do anything to help you, that you just said out the clear blue sky out the top of your head and came up with these numbers. But if your budget if your actual is only off by a little bit on your budget, that means you did a good job and you're very in tune to what you're spending and monies that you're earning, and you're really watching your monies and making sure that you're growing. you have what you call, like I always like to say, when you're developing a budget for revenue, you have lukewarm, cold, and hot. Lukewarm is something says, I have a meeting with Kieta and she wants me to work with her organization. That's lukewarm. Hot means that Kieta says, come to my office so she can hire me. That's hot. Cold is, boy, I would love to work with Kieta and hopefully she can give me some work. There's a difference. So when you're creating your budget, what you want to put on your budget is more lukewarm and hot, not cold. Same thing in expenses. It's the same analogy. Sorry, excuse me. Cash, shareholders' equity, stock, net assets. I'm not going to go through this too much. This is more for profit. Then you have a statement of cash flows, which I really like to talk about a lot. You have your net earnings from the previous year. I mean, at the end of the year, that's the revenues over expenses, or expenses over revenues, or net profit, plus your depreciation less any working capital, and then these are all falling under your operating expenses. It could also be the variance between all the items on your balance sheet, such as liabilities and accounts receivable and prepaids. But then also the next item is in your investing. I bought some equipment. I bought a nice truck for $15,000. I spent money out. That's why it's in a negative for $15,000. Oh, but I spent that out. But I wanted another vehicle, or I wanted something else, and I had went to go receive a loan from the bank, and they gave me $170,000. That's an inflow. But I was also paying on that loan. The outflow of that $8,000. And then you have a net increase in cash of 172. I started the year off with 11, but now I'm closing the year out with 183,000. Expense reporting definitions. Expense reporting is a report used to track business spending, showing how much money is being spent within the whole company, a project, or a department. What's the purpose? Expense reporting is important for business and audit purposes. Notice what we said, audit purposes. Let's understand something. All organizations do not have to be audited. But if you are going to receive monies from an organization that is being audited, that may make you subject to being audited. So know who you're working with that may have your requirements there. A lot of people say, why do I have to have all this expense reporting? Because that organization that you're receiving funds for may be under the requirements that they have to have that supporting documentation, which means that you have to have that supporting documentation because it's a trickle-down effect. This is what happens with BCYF. I heard that a lot. Why do we have to have such stringent guidelines on expense reporting and having all this supporting documentation and doing all that? Because receiving money from the city and they're requiring us to do this. So instead of us having to have the city pass down and come speak with the grantees or subrecipients, BCYF takes the burden on themselves and requests all this from you, work with us to make sure all that is correct, so that now when the city asks the questions, we can provide all the support they have so they don't have to speak with you, which will limit you from having to have an audit report to being issued. Some organizations are large enough, or the monies that receive require audits. And if they do that, they follow charitable nonprofits. In most cases, may have to have an audit, or the grantor may request that, or the state and local department may request an audit from you. But also at the same time, if you expend more than $750,000 in federal money, that could be monies that's passed through or directly from the federal, then you require what they call a single audit under the Uniform Guidelines, also known as A133. And that's when you expend more than $750,000 in expenses, not earnings, not how much you receive in revenue, expend. So you could have received $500,000 in revenues through pass-through entity, through the federal government, or through a pass-through through the state, which their monies came from the federal government, and you only spent $500,000. But they didn't give you all your money. So your budget had said that you were going to spend $1 million, and you actually spent $800,000. Then you're required to get that. You're required to produce a A133 audit, a single audit, because you expended more than $750,000, but you only received $500,000 in revenue. They're looking at the expenditures, not the revenue. Also, other purposes ensures employees comply with regulations of spending within the company, allows employees to get reimbursed for out-of-pocket expenses that was paid for related company businesses. This is all expense reporting to make sure everybody's keeping up with what's going on. Preparation for expenses. What you want to prepare for, things that you want to have, dates on the expenditure incurred, match with the date on the receipt. Please look at the dates. I bought this on January 1st, but then you're trying to provide a receipt for something on March 31st, and you're submitting it with your March 31st. No, they have to match along with the nature of the expense, such as airline tickets, meals, parking fees. The amount of the expense must match between the receipt and what you actually paid out that came out of your bank statement or through your check or whatever receipt like that. The account to which the expense should be charged. You should be able to note that to know where it's going to be showing up on your expense report. You may write it on the receipt. This is meals and entertainment. This is contractor monies. This is employee reimbursement. The subtotal for each expense. Subtraction for prior advance. I gave an employee $200 early, and then now it's time for them to get paid, and I'm taking my $200 back. You want to note that. You want to show the cancel check or the receipt to show that I did pay them previously. Now it's being deducted. So when you submit the documentation, you're showing their employee register that shows that they received monies they're supposed to receive $1,800, but they only received $1,600 because you're attaching the documentation to show that I had gave them an advance for $200. The grand total amount of the reimbursement requested, if there's a bundle, you may have a bundle that says I'm looking to receive $1,069, but I have 15 receipts and they're all bundled up. You may have a receipt total on there or some type of cover page that shows that all the receipts behind it and that you can trace those numbers. And when we say that in audit and trace, look at the number on that cover sheet that says $69.79. We lift up that cover sheet and there's a receipt or invoice that says $69.79 right below it, and then so on, and that you can say it all rolls up to that $1,069. So we want to look at those type of that's the bundling and grand totaling of reimbursements that may come along that you're trying to be reimbursed for expenses. Allowable costs. That's a big topic for a lot of times in nonprofit organizations, and also when you're submitting things through the governmental agencies. There are various types of costs, allowable costs and unallowable. Let's go down to the last one, utilities. Utilities is the type of cost. Allowable cost is allowable only for utility costs directly related to rental lease space agreements for the program. Should never be used for personal. So, for instance, here's something that may happen. I have a office downstairs in my basement exclusively for my basement, and it's all commercialized, set up for commercial use, and it's set downstairs in my basement. And it's being and upstairs is where I live. I pay my landlord for the upstairs for personal, and I pay my landlord downstairs for commercial use. Well, the business downstairs is an allowable expense, but upstairs is not, because no portion of your housing or personal living space may be charged to the grant. If it's personal usage, it's unallowable. Same thing with the utilities that go along. We say, how do I divide up the utilities? Well, you may divide up the utilities through a breakdown of the square footage or the number of rooms to be able to come to an acceptable breakdown of how much you can deduct for program expenses when it relates to utilities, the use of that area, or things of that nature. And the same goes for if you're splitting amongst programs and you're working in an office and you have 5 different programs and you pay $2,500 in rent a month, then those 5 programs, if they're separated equally, will be able to deduct show on their expense reports $500 a piece. So those are different things that you want to look at with allowable and unallowable costs. That's our presentation to start off with there. I know I went through this. I tried to give as much example as possible. I know it's the end of the day. I try not to have everyone bogged down by going through so much as a long-winded, because it gets toward the end of the day, but I hope I did not go too fast. We are open for any questions that you may have. have a Q&A in the chat. How do you recommend projecting out a year's budget with what software or approach? Well, a lot of times, to be quite honest with you, I've seen from a large organization all the way down to small organizations, they really like utilizing Excel. And they create different spreadsheets because it gives them the flexibility of adding and deleting different accounts, and also being able to create additional columns that break down. The more detailed you are, is the better. They break down between the different areas or different programs, and they roll it all up into one big program. And I always want to say, recommending and projecting out the year's budget, you want to look at last year's to start. You want to say, my last year, I grossed $2 million, and my expenses was $1.9 million, and I had a profit or revenue over expenses for $100,000. Then if that's the case, then you want to start with the $2 million and say, I have that much in revenues last year. How much of those $2 million will be reoccurring for the next year? Now I go into my lukewarm and hot contracts to add on to that. And then I look at my expenses. How much of these expenses are reoccurring? And then I add back in onto there, and also look at the expenses that may be projected that's needed for that new contract that's coming out, that's being added. I was curious about when we as nonprofit would be required to report out a 990T for selling goods. If we sold T-shirts and posters with our logo and values printed on it, would that be in alignment with our mission? What is the line there? It's very tricky there. You have to look at your mission and see what is your mission statement actually saying. But I will say this: if you're selling goods, then you need, and you're charging someone money, and you're bringing monies in, and you're creating a cost of goods sold, and you have a profit that's left over, you should be paying taxes on that profit. You definitely talk to your accountant / CPA tax preparer to go through that with them to make sure they're doing that. Now, if you're creating your T-shirts to give out to youth at the camp or to adults or anyone, and you're giving out to them, then you would say, I'm just giving these out with no cost or anything like that. That's a different story. But if you're looking to make a profit, that's what they're going to say. Am I looking to make a profit? And that's what they're looking for. And that line item would go on there, and I would keep it on a separate line item, to be honest with you, in my financial statements, so I can definitely separate out how much money that's earned, grossed in with gross from the selling those T-shirts, how much money was directly related to the cost of purchasing those T-shirts to be sold, any other expenses, and what the profit is, because that's a completely separate tax return within the 990 that your accountant, CPA, or tax preparer is going to have to prepare, and they're going to ask you to break it out later, or you might as well do it in the beginning so it'll make it a lot easier. Like we mentioned earlier, we want to work smarter, not harder, and we want to have items broken out as best we can for easy access to be able to show your taxes and do it. Have you used QuickBooks for budget control? If so, what has your experience been? Yes, used QuickBooks before for budgets. It works well, but like I said, I've been doing this for over 20 years. I always would take the QuickBooks and roll it over into Excel and create my own. Software sometimes limits you. They don't give you as much full control as what you want to do as far as creating things. I mean, literally, I go to the point I'm projecting out, doing crazy stuff, saying, okay, if I open up something in another state and do this right here, then I can play with the numbers and come up with this and do all that. And then I come back to my actual real budget because I said, hey, this is out of control. You know you're not going to open up in another state in Wyoming or open up another state in Montana. You was just playing around. But you're allowed to do that because you may have talked to Kieta, who says, I have another office in those areas, and I like using Kieta's name, in another state, and she may give me some money to go out to Wyoming and do some business, or Montana, and hey, this is a code, but I want to be able to have an intelligent conversation in case it does come up, and that happens in case that may happen, and that's what the Excel allows you to do. QuickBooks is going to keep you in the confines of what's in there from your past and what you may be projecting going forward by adding a certain percentage, like on each expense, 3% on each expense for the cost of living adjustment, for example. What is your opinion on what, oh, and thank you for your response, thank you. Also, what is your opinion on what a board of directors at a nonprofit needs to see every quarter? They approve the budget annually, but do they need the projections based on actuals or just dashboard with the cash flow? I'm of the mindset that they need the dashboard and the cash flow. They also need a little bit of projection, though. I'm not going to kid you that you want to do that. Always remember, the board of directors' job is to guide the nonprofit through their based on their mission statement and where they're trying to go. They want to guide them along. They're not there to sit there and tell you how to run the organization. That's what the officers within the organization does every day. On a day-to-day basis, they're making sure that the organization is carrying out all that the board of directors said, hey, we think that we want to go in this direction and this is the direction that the company wants to go in. They're carrying that out. But the board of directors don't need to get into the detail of various line items, because then they're going to start going away from what their job is, which is to make sure the mission is being carried out and the direction of the organization. So dashboards they do work very well, and most board of directors do like the dashboards because they just get a quick snapshot and they can move on and make a decision. And I would suggest also, last thing I would say, on a quarterly basis or something like, you give a good detailed overview by going through the financial statements to keep them abreast so they can make intelligent decisions. All in the chat. There are no more. I'd like to thank everyone for listening. I hope it was very helpful and informative. And please, later on, if you have any additional questions, I'm pretty sure that you can continue to submit those, and then we can respond to you via email. And we thank you very much for allowing us to take the time to talk to you this evening. And I hope, as I said before, I hope it's informative. Please, good luck and continue to move forward. Everyone needs your assistance in the community for all that you do, each and every one of you. And it does, and it is greatly appreciated, and it doesn't go unnoticed. Thank you very much.